All right, everybody, happy Monday. Kevin coming to you once again with Weeds Weekly Wrap, where we're going to go through, hey, what happened this past week, what we can expect this week, and then just some thoughts as it pertains to the real estate market, our clients, and how we should be thinking about what's coming in 2024, right? Some random thoughts from yours truly. Some feedback I've been getting recently is a little long-winded at 15 minutes, so I'm going to do my best to keep this under 10 minutes. I do have a lot to say. Anyone that knows me knows I am long-winded at times. That brain just keeps spinning and I like talking. So, hey, it is what it is, but let's just dive in. And obviously the biggest thing that happened this past week, which we thought was going to be the biggest data point, was that jobs report on Friday. Blowing away expectations, coming in twice the number that was anticipated and causing rates to go up, right? Rates increased that day anywhere from a quarter for some people, all the way up to, I saw roughly about 3/8. It just depended on your credit score. Once again, credit score being really important. The other thing that happened this past week, right? The Fed made their announcement. And really, no fireworks as anticipated, but they said two main things. And the biggest things, hey, consumer prices still remain elevated, as well as services. I can tell you that from being in the flipping and construction side of things. And the other thing they said is, hey, a March rate cut, they believe is off the table unless something drastically changes. Again, we've discussed, I don't believe the first rate cut is coming until July, maybe possibly June, but I think July is going to be when we get that first Fed rate cut. And it's just due to jobs. It's due to the strength in the economy that's showing. It's due to inflation is still sticky. And I just think the Fed is really in a rock and a hard place that they can't really do anything because nothing is certain at this point. So let's also, what happened last week, well, before I forget, a huge thing happened is the banking sector seems to be a little bit on shaky ground again. We had New York Community Bank Corp come out with their earnings report on Wednesday, and they sucked. It went all the way into the negative. It once again showed that a community bank could be under stress, given commercial write-offs, losses from acquiring other assets from banks. And it just provided a glimpse in the fact that, hey, the market was really uncertain. And what it caused a huge dip in interest rates. Actually blew away the floor. We got all the way down to, I want to say 3.82% on the 10-year treasury. We haven't seen that since December and going all the way back to May. So it was fairly significant. And I'm going to talk a little bit more about that in a second. The other thing I wanted to point out is, look, I said it last week and I'm going to say it again. These next 5 weeks to me kind of set the tone, especially the remainder of Q1. I know we have big data points, like we have CPI next week, but to me, every week here on out for the remainder of Q1 is critical. It is going to set up what the Fed is going to do and when they are going to do it. So you want to make sure that you're talking to your mortgage professional, you're in touch with them, listening to what they have to say, digesting as much info as you can, and making sure, especially, that your clients are in touch with their mortgage professional on a daily basis if they're interested in purchasing a home or they're under contract more precisely. The other thing from that jobs report, I read some interesting things over the weekend, and one thing that was pointed out to me, and I think the weekend is going to give traders an opportunity to digest that report. And it's going to be interesting. Do they come out in a very cautious approach and say, shit, we just got burned again, so we're going to be extremely cautious and it's going to cause interest rates to rise a little bit? Or are they going to digest that jobs report that basically was double the number? And I believe it was more double the number because of the Bureau of Labor Statistics, the BLS. They actually manipulated what the data point for how many hours in a week that they constitute full-time employment. It went from 34.3 to 34.1. Not a huge difference, right? When you think about it, you're like, wow, that's small. But when you're dealing with millions and millions of people in the workforce, it can really skew a number. So, it's almost like we're working apples to oranges now and how investors and traders are going to digest that data. So fingers crossed that rates will come back down, but I predict they're going to be a little bit cautious. And it also is just reconfirms that 4% is the floor. Look, until we get any significant data points of inflation coming down, jobs starting to stall, and the Fed is starting to feel a little bit warmer, look, 4% is our floor. Make no mistake about it. Let's not think otherwise. We may see blips and stuff like that of, it comes down for certain things, but 4% is our floor. And that brings me to the point, you need to be close in contact with your mortgage professional because of events that happen like New York Community Bank Corp. It caused a rally that day in the Treasury market. Interest rates dropped anywhere from 1/4 to almost 0.5%, depending on what program you were going into. If you're not in communication with your mortgage professional, how would you know that, right? So my point is you need to be prepared. I think that the market, right, it still has a long way to go. We are not out of the weeds by any stretch of the imagination. And I think there's a lot of things that could potentially, including us abroad right now with what's going on overseas in the Middle East and everything, there's going to be opportunities like that I think cause traders to have uncertainty, enormous uncertainty. They may flee the stock market, pour some money into treasuries, and that's going to be lock day. So you need to be ready and you need to be in contact with mortgage professionals. Your clients need to be, but you also, so that you can pick up the phone, right? It's all about contact. It's all about reaching out to your clients when you can. And that brings me to my last point. My last point is, look, it's time to save money for some of your clients. If your clients actually purchase the home in, say, the September, October, November timeframe, depending on when they had to lock in that interest rate, it's time for them to refinance. Let's not forget that we were at over 20-year highs. We were over 8%. We are now well below 1% lower in interest rates from that standpoint. But I want to point out that they need to be doing a refinance that's a no-cost refinance. So the opportunity for you is to call them up, say, hey, just wanted to reach out. How's your home? Hope it's going great. Tell me all about it. Have you guys moved in? Oh, and by the way, you should be reaching out to your mortgage professional, whoever it is, or shopping it around and getting a no-cost refinance. And the reason I say no-cost refinance is because they just paid thousands of dollars in closing costs. They do not want to pay them again, especially with the anticipation come 2025, 2026, rates are going to be decreasing again. Right? Rates are going to be on their way down. So they don't want to pay those costs. But I ran some numbers just really quick. If you got a $300,000 loan amount and you're able to decrease your interest rate by 0.75%, which is very possible in today's marketplace from where it was at the highs, you'd save $152 a month. For a $500,000 loan amount, you save $253. For a $750,000 loan amount, you save $380 a month. $1 million loan, you're talking $511 a month. And a $1.5 million loan, you're talking $766 a month. Again, you want to use the bank's money right now to put more money in your pocket. Yeah, I get it's going to be reamortized at 30 years, but no one's going to pay off the loan in 30 years anyway. It typically never happens. So I wouldn't worry about that. You've only closed, 5 months ago, 4, 5, 6 months ago. Take advantage of these lower rates. Do a no-cost refinance. No money out of your pocket. Take a slightly higher interest rate, your client does. Use the bank's money to pay all those title fees, pay the appraisal fee, and get a lower payment, as you can see, and put that money in your pocket so that your affordability on a monthly basis for groceries and everything else that's going on in your household is a better situation for you. And you, as the agent, could be a hero in reaching out, another touch point to give them that advice. All right, everybody, have a great week. Once again, trying to keep this under 10 minutes. You have any questions, don't hesitate to reach out. I love talking shop. You want to grab a coffee, whatever the case may be. And I'm always here to help you or your clients at any time. Look forward to talking to you soon. Have a great week. Happy selling. Cheers.